Hey, I'm Cale Thomas, broker owner of Elite Properties Direct, and I have the broker owner of Vault Financial with me, Wes Hankins. What's up, Wes?
What's up, Kale? Happy to be here, man.
Hey, so Wes and I kind of like essentially grew up in the business together for a lack of better terms. We both were doing loans.
hmm
Gosh, when that was like early 2000s, right?
So,
Early to mid.
yeah, I went full-time mortgages, I believe, in August of 2005.
Okay.
And then within 12 months, the world was basically falling apart. So I feel like the
Yeah, that
business
was a
model,
whirlwind for you, right?
oh, I mean, you might have got in a little bit before me, but it wasn't a massive whirlwind for me. But in hindsight, it was a blessing because
Yeah.
I graduated in college of June, July of '05, went full time in mortgages. I never saw the easy money. I never saw the, crazy negams and all of this stuff that we heard about. But meaning I went from making whatever 30 grand a year to 80 grand a year, and I'm balling where a
Yeah.
lot of guys around us were making hundreds and their income got hacked. And so they're losing all their stuff. But for me as
Yeah.
a young kid, everyone around me was saying how bad it was and how horrible things were. And I was like, oh, this is pretty good.
You're like, I don't know any different.
I didn't know any different. And,
Yeah.
having a formal education in finance for me, I didn't have to unlearn a lot of things when we transitioned into more of a normal mortgage market, getting away from the stated income and things like that, where so many of the guys that were ahead of me or older than me, all they knew were those what we now reference subprime loans or subprime market. So
So
it was
that's
it was a
like
whirlwind.
that's a funny thing right there because you and I know that market because
Mhm.
we were in the tail end of that market. But a lot of people, like a lot of successful people in our industry right now, have never seen those loan programs, and I don't know if they really understand how much of an impact they had on '09, 10, 2011, et cetera, the whole meltdown, and like why today is different, like why mortgages are a little different today.
Well, so what's funny about that is now that I've been in the business for 20 years, that topic comes out more than you think because we have guidelines in place now that underwriters or managers or people don't understand the context of the guideline and why the guideline
Mhm.
exists. So I end up having to call underwriters or call people to reverse a denial or reverse an issue and say, actually, you're wrong. Here's why. Go run it up. And it was because we lived it in real time. We were doing loans, doing real estate while the world didn't change over once, twice, three times. People forget we revised the disclosures with Dodd-Frank, with CFPB, with the good faith estimate, with the loan estimate. All of these things happened three, four, five, six times. And they're very, very successful people now that honestly live in almost in a naive world where they don't know how it was, how it could be, how things have changed. And it comes up a lot. And I see it a lot. And what I have to sometimes do is go, okay, Wes, does this even matter? Do I need to bring this up? It could be a
Yeah.
problem, but do I even need to talk about it? And that is a valid point to bring up.
Yeah. That's really interesting. So, okay. So, obviously, like, we came from that world and we saw like the other side
Yes.
of this. And now we're starting to see that, like, the reason we're having this conversation now, today, is we're starting to see some things come back in the marketplace, like some situations set up, if you will, that could lead to something like a short sale market, like
Correct.
a pre foreclosure market. And we'll talk about Zillow pre foreclosures in a minute, but
Correct.
like,
And that
say
that's
something about that.
yeah, so that's kind of why we're here, right? Because there are things that those of us who've been around know. We don't even think about it because we just assume that other agents, other brokers, other loan officers just know. And not only do they not know it, they don't even know these words, they don't know this context. And this whole conversation kind of was sparked by, something that popped up, whatever it was, last week that was commonplace when we were trying to figure out how to pay our bills in that defaulted market,
Yeah.
right? So So remind me again. So you kind of transitioned out of loans almost 100% into real estate around when?
So it really was the default market that did it for me. So, in like around 2007, I went out on my own. So I left the shop that you and I were at, and I
Hmm.
essentially was trying to replicate the same thing, right? I was
Right.
buying leads on the internet and doing refinances and set up with my own wholesale lenders. And then the crash happened, and I think you and I were in a position where it was like we have to reinvent ourselves because what we were doing, 2 months ago or 6 months ago, it wasn't working at all. And we had to find new ways to bring in income. So I think you and I, by necessity, like you mentioned, pay your bills, we had to sell real estate because it was like, well, shoot, I have a real estate license and there's a need for people to service the real estate industry right now because most agents were just leaving, just throwing up their hands and like, I'm out.
Yeah.
And so, for example, I remember using Craigslist to take REOs. I would call the agent, hey man, I see you got, 10 new listings in Temecula. Can I advertise those for buyers? Sure. Because the REO agent was like, I don't have time to deal with it. I don't care. Like,
Correct.
shout out to Bob Cadez. He used to let me advertise his stuff all the
Yeah.
time.
So those of you who don't know, an REO agent is a realtor that gets assigned bank-owned properties. So at that time, literally this was, I don't want to say it's pre-internet because the internet was around at that time, but we were barely even having a digital MLS. I mean, people weren't even putting I mean, iPhones weren't even out yet.
It was, I would say, like real estate on the internet was in its infancy. So it had a lot of bugs to work out.
Correct. So at that time, contextually, we were forced into it. I like to when I've done some trainings in the past and I talk about my career path, is that I was young in age, but I already owned two properties. I already had a wife. I already had a kid. Compared to many other people that were in the industry, the mortgage industry at the time, where literally there were recruiters going to, gas stations and
Oh
grocery stores saying,
gosh, I
"Hey,
remember
come
that.
on board."
Yes,
I
totally.
was I was already in my adult life going, I can't go back to my old job. I have to press forward. So out of necessity, like you said, in California, being licensed in the DRE at that time, loans, real estate, not a big deal to do both, either one, not a huge deal. So you sit back and go, well, there's no refis happening, right? All these people are upside down. And then now, if you were a listing agent at the time doing standard sales, you were hurting, right?
Yeah.
So what was left? Well, let's go work buyers, right? That's what I remember is just saying, and I think you and I were doing the same thing where it was like calling up the Bob Cadez's, the Charles Santoros, a lot of these big names that were getting assigned lots of foreclosures at the time, and at that time, just marketing them. I remember having a page of REOs in the Homes and Land magazine just to
Gosh,
make
yeah.
the phone ring. And
Yeah.
at that time, I mean, I joke it could have been my mom's funeral, but that phone rang, I'm going to answer it because it was
Yeah.
like it was a really hard time, and I actually think it was a blessing that I was young and naive to not realize how broke I was, how close I was to like losing it all, right? So that grind of just, okay, well, it is what it is. Let's just go. I mean, we're showing a property in, down by the border, we're showing a property in Ventura. It did not matter. Get in the car, show the deal. And that's, I think you and I both were forced into that market. But like I said, in hindsight, there was a lot of blessings in that market that I think the agents at the time were boo-hooing themselves, not recognizing the opportunities. And that is kind of why we're here today, because I think that we are starting to recognize some of those patterns that happened at the time and want people to understand that there's always money to be made in the single family housing market. Like it's just how you want to do it.
Yeah. And I think like getting back to that topic of short sales, a short sale is something that you as an agent can absolutely add value to for your clients, and they may not even know that they need you. So I think it's like a prime time to start getting the word out about what is a short sale, why would you even entertain going down that route, what are the differences between a short sale and a foreclosure, and all these types of things. Um, so kind of to dive into like for your realtors that you're working with right now that haven't seen the default market, like what are some things they could look at or listen for or hear from their client to go, shoot, maybe we should look at a short sale, or maybe we should talk about the short sale process with this particular client.
Right, 100%. So part of the reason, even though I'm doing home loans and I am a mortgage lender, the reason why I have a voice on this is because I came up in that defaulted market, right? So I through these conversations, I've quickly learned how, like, I'm basically mixing my real estate brain and my mortgage brain together and answering questions. And it took me a while to go, how do you not know that? And then I realized, oh, it's 2025. You have short sale hasn't been around, for 2015 really, and you've never even seen this stuff. So of course you don't know that, right? So things to look out for, right? On the listing site, this is a common thing that, believe it or not, every agent is just assuming the sellers have equity. They assume that there's a lot of money. You'd be blown away how many things I've seen where the listing agent did not find out the terms of that mortgage, right? And that could be the conversation on that could be, is it an FHA making it fully assumable? Is it a VA where it can make it assumable? What, again, are they current? Are they making their payment? And then what are they going to owe? We assume, again, going back to the assume is that listing agent is doing a seller's net sheet showing what the proceeds are going to be, but you'd be blown away how many don't think about that because they've never had to deal with a situation where the client bought it for 550 maybe 24 months ago, put down nothing or put down 3%, or put down down payment assistance programs, things that have a second mortgage on there that you don't know out of the gate, and now they're getting divorced, having a job change. Something's happening where they have to sell it sooner than they thought they would. And long story short, after selling it, paying commissions, paying closing cost credits, whatever back payments are on there, whatever second mortgage is on there, whatever solar is on there, the client's upside down. So that introduces the short sale, where essentially we have to go to the bank, or the agents have to go to the bank and ask for a price lower than what the client owes on it. So when we use, and I want you to take this part over where we've used the verbiages, short sales, pre-foreclosures, there's lots of verbiages in there, but that's the long and short of it, of like selling it for less than what you owe on it, right?
And yes, and the short sale name is even kind of confusing to some people because some people think it's like, oh, it's a short period of time. Like
Correct.
we get it done and we got to close really fast. It's almost the opposite. It's kind of an ambiguous amount of time, if you will. However, I will say like short sales that our office has processed recently, we're getting approvals fairly quickly, like in under 30 days. So when I say approval on a short sale, you physically have to, in most cases, have an offer in hand to present to the bank as kind of a scenario, if you will. Like, hey, we'd like to do a short sale. Here's a bona fide offer that we got from the open market, and here's how the numbers break down. Will you approve it? And then the short sale lender, the bank, will get their own appraisal and they'll run numbers on their own and come back and go, yeah, this is the number we want. Here's how much
Correct.
we'll approve for commissions. Here's how much we'll approve for closing costs, whatever. And they'll give you an approval based on that. So that process right there is what I'm talking about. Like that, sometimes that used to take 6 months.
But keep in mind, why did it take so long?
Well, because you got to go
They
out
had a
to the
bunch.
investors and get all the investors to agree. And then sometimes you have these mortgages bundled and multiple
Or
investors are involved. And it's a,
or even they were just backlogged. They had a lot
yeah,
of them in process. Where
that
right
was a big
now,
problem too. They had so many of them. They just didn't have
correct,
the manpower to get through everything.
correct,
But
yeah. So
nonetheless, I think the good thing about that default market is they worked out a lot of those bugs. Sorry, I cut you off.
no, no, you like you said, you hit the nail on the head. But at the same time, you spoke about something that is so commonplace in your brain that I bet you a lot of agents or even consumers don't understand, that the client still owns the home. So if Cale is not making his mortgage payment, he still owns the house. It is a lot of people want to bypass the owner, right? And so Cale, if he is the owner, has to make the decision to say, I'm going to sell my house. And so we're going to put it on the open market. That listing agent that he hires they're going to put a list price on there. But what do we know about that list price? Doesn't mean much,
Yeah.
right? Because now if the agent gets an offer in and Cale, the homeowner in this example, says, okay, I'm gonna take that offer, I accept that offer, but the whole offer is contingent upon his lender accepting that price and those terms, right? So when you're talking about having it reviewed, that is the review process. And we used to see it all the time where a house would be valued at 600 grand and the listing agent puts it out there at 200 grand and the whole valley loses their mind. But those of us who are experienced
Yeah.
know that, guys, it's not going to sell at 200 grand.
Yeah.
Like it's because part of the process of the short sale is that I don't want to say the bank, the servicer, right? The people you make your mortgage to, they will send an appraiser out there. On top of that, they do what they call BPOs, which is they hire realtors or broker price opinions to also get a value on that property. So their objective is to capture as much profit as possible. So if the note on the home, the mortgage is at 800 grand and your offer is at $200,000, but the appraisal comes back at 800 grand, they're not going to go to 200 grand. And that's where we used to experience the time lag of, okay, this seller accepted your short sale offer at 400 grand, but it was taking 30, 40, 60 days, 90 days just for them to come back and say, sorry, not going to work, right? And I think that's my big motivator now is to start talking about for these agents. That big point right there is the list. What does the list price actually mean on a short sale, right? Like it doesn't mean everything. It doesn't mean the banks can accept that. Doesn't mean anything. And then honestly, like what buyers are best suited for a short sale, right?
Yeah, gosh, there's so much right there. I guess one
Right.
quick thing before I forget. I think like pro tip on pricing a short sale is it's a balance between what's the realistic value of the property in its current condition. So meaning like if average homes are selling at 800, maybe your home's worth 760 because they have some deferred maintenance or whatever. But you want to have it low enough that it's going to attract buyers to get that everyone in the valley, freaking out about it moment,
Right.
but high enough that it's within some sort of a realm of like where it's going to appraise. So if it appraised at 750, and we kind of have an idea that like that's the fair market value 750, I wouldn't
Right.
price it at like 599, but could you price it at 725? Probably.
Right.
It's close, fairly close. Would you get a counter back from the bank? Maybe they would go, okay, we'll give you a little bit off because it needs carpet and paint and the backyard's trashed or whatever.
Right. You can prove it. You can prove that a
Yeah,
property is in distress.
but you got to be close. You can't be like way off.
Correct. So problems that we remember back, problems that we saw at that time were the agent would list it low, they would accept an offer low, and that client was maxed out. Meaning if the bank came back even 20 grand more, the client couldn't afford more,
Yeah.
wasting everybody's time.
Yes.
That was very common. I mean, we used to see that quite often. Me on the lending side, I'd be like, dude, this thing comes out at 500 grand. The banks are also going to see these comparables. They're
Yeah.
also going to see them. They're not going to accept 350, you know? But on that, right? When you're looking at it from like an investor perspective of going, oh, but I want a good deal. Let's put it this way. Are all short sales good deals? Well, good
No.
deals are relative, right?
Yeah.
We did have some where, like even my house, like it comped out as a pool, but it was a really nice pool where on an open fair market value, that nice pool might yield higher profit, but on an appraisal, it's kind of like a pool's a pool, right? So when I bought my short sale, that didn't really factor into the appraised value. So like, though you could argue I paid fair market, I got a good deal because that was a nice pool. Does that make sense?
Yes. And I clearly remember, this is total sidebar. I clearly remember a time in the real estate market where the defaults were so bad that appraisers weren't giving any sort of value to
Correct.
extras because they were scared to like put their license on the line. Meaning, I sold so many homes to clients that had probably $100,000 worth of upgrades in a backyard, and they gave them like 5 grand additional value for it. And it was just like mind
Well,
blowing because that would never happen in today's market. But yes, I totally get what you're saying.
so with that though, and I don't want to sidetrack too much, but that's the appraisal part of it is such a good topic, and it's going to be important as we move forward because what a lot of people don't realize is that the appraisers got blamed for that down market, right? They got
Yes.
blamed, and I think it's hurt us moving forward. But now these appraisers, their hands are even tied even more, right? So I had to have a conversation with one of my loan officers a couple weeks ago where he had two contracts where the house appraised higher than the purchase price, right? And he's like, I haven't really seen this. And that's because he's been cutting his teeth in the market where we've been climbing, right? So now that we're starting to stabilize, you might see a house on the market where it comps out at 720, but it's going into escrow at 7.
Yeah.
And what is that going to do? That's going to change the comps for the next listing, right? So what realtors and consumers and people need to know is that though real estate is emotional, the loans are not emotional. And a short sale process are much more of a mortgage, it's much more of a non-emotional transaction,
Yeah.
right? So these appraisers have to go out there and so much has changed in the appraisal world. I'm curious to see how it's going to work out. But back then, it was like, what do you do? Do you use a short sale as a comp? Do you not use it? What happens when they're all short sales? What happens when one was a bank owned home path property that was all new paint, carpet, appliances, and the other one was a HUD foreclosure that wasn't accepting FHA, VA?
Yeah.
There's so many variables that at
Yeah.
that time, everybody heard those success stories where, oh man, that guy got a smoking deal on the short sale, but the deals were immeasurable, right? The market was so wild, and the last 5 years, really since COVID, everything's been what we call a standard sale. Everything's a standard sale. Everything's trying to make more and more money. The next comp's more than the next comp, but in a normal market, there's a percentage of foreclosures. There's a percentage as areas get older, there's percentages of homes that are haven't been touched in 30 years or have been fully gutted. And our pocket of the world, Mirrored and Temecula, back then everything was 20 years old.
Yeah.
This one had black granite, this one had blue granite, whatever it was. It was really hard to comp out on an appraisal. So yes, in my example, we had my backyard was a smoking backyard, all the fun stuff that didn't doesn't really go into an appraisal because there really wasn't any comps out there to compare it to. And like you said, at that time the appraisers were going through this, they're just getting hammered because that
Yeah.
was the infancy stages of all of the new laws coming
Appraisal
into play.
reform. Yeah.
Appraisal reform. Yeah. Yeah.
Yep.
And so now, and I don't know how familiar you are with this, but the last couple years, last 12 months really, they've introduced even more appraisal reform where we're now having they call it a PDR, but it's like a BPO. Like somebody goes out there and does photos of it, but then a desktop review, meaning no actual appraiser goes out there. So moving forward, any smart agent has to be aware of these short sales and how they're all going to operate, right? Because between servicers and for those of you who don't know, the mortgage might be owned by Fannie Mae, but it's being serviced by Wells Fargo, Chase. So whoever you make that mortgage to, that is the servicer. And their job is to also manage the default process all the way, many of them all the way through foreclosure as a foreclosure. But it starts with Cale's not making his payment and want to short sale the home and that whole process. So at the time, we all kind of knew like, oh, Wells Fargo does it this way, Bank of America does it this way, Aquin does it this way, right? So, and again, that was very high volume. I don't think we're going to see that kind of volume before, but a normal market has some of this in it.
100%. And I think like we've had a couple scenarios now, like some of the things in my mind that flag this is like, hey, wait a minute, we've seen this before.
Right.
is twofold. That market that's stabilizing slash maybe even correcting a little bit right now, mixed with people that were making a bet, 2, 3 years ago that the market rates would go down, and they took out a 2-1 buy down on a
Hmm.
home they maybe weren't so comfortable on the payment with. But now that those payments are adjusting
Right.
to the market rate at that time, whatever they took out, their payments are increasing significantly, and they don't have a refinance market right now necessarily. And they may be in a situation where the home's actually worth less than what they bought it for. Now, if you mix that in with a job transfer, a divorce, or whatever, military, they're getting shipped off somewhere, whatever the case may be, they might be in a position where they have no choice. They have to dump the house. I hate the term dump, but they have to sell the house or get out from underneath the house, and they may not have any equity. That to me seems like
Right.
short sale would be my first thought. But what are your thoughts on that?
Right. So that begins to beg the question, right? So if a client calls you up and says, "Hey, Cale, I owe 600, comps are like 620, 630," out of the gate, like, okay, well, commissions or whatever's going on. The question then becomes, why are we selling? Right? So one thing that I've talked to clients about and all of these things over the years is that new construction. Okay. When you buy new construction, everyone's closing on those phase of homes. The phases used to be a lot larger. Now they run between 5 to 12 homes. Okay. That means all of you guys are moving in. You paid roughly the same price. You have the same interest rate. All of these things happen. Okay. Versus, let's use my Meadowview in Temecula. And the houses range from 1965 to brand new, right? Meaning Wes paid 500, Cale paid 2 million. Everything's all over the place. We all are in different statuses, and that is normal for an old neighborhood, right? So quite often, when you are a consumer all buying in brand new homes, the likelihood of even one person, something happening in the neighborhood is pretty high. Something. And it could be something catastrophic. It could be we did an FHA Cal Halfa loan, down payment assistance program. We can afford the payment. Everything's fine. But then, God forbid, I lose my spouse in a car accident. Okay. Now, we all know financial planning, life insurance, but let's just assume they didn't do that. Okay. That person now doesn't know what to do. Maybe they do list it and it doesn't sell, or they end up having to short sale it and causing a comp in your neighborhood. Now, what I always tell people, like, look, man, value is only what someone's going to pay for it. But our real estate market is driven by mortgages that have to have an appraisal. So if that comp throws you off in that brand new neighborhood, these appraisers are not going to skip over it. Now, when you compound that with a normal market means I looked at this house and then I looked at that house and that house and that house. That doesn't mean we looked at 500 homes, but it means this property that you're trying to offload, like you said, maybe you went through a financial time where you didn't have enough money to keep up on it. It needs sod, it needs carpet, whatever it is, it just doesn't appeal compared to this one down the way. So, bada bing, bada boom enters the fact where you're like, I just can't sell it. I can't get from underneath it. And I like to tell people that doesn't mean that you made a bad financial decision. It doesn't mean that buying that home was a mistake in any capacity. It's just that things in life do happen.
Yeah.
And I always tell people that the first 5 years of home ownership is the scariest because you can never be a second time home buyer who rolls over a bunch of equity unless you're a first time home buyer who starts building equity, right?
Yeah.
But in a normal economic cycle, some people have a good 10 years, some people have a bad 10 years, and things just happen. So we all know, as much as we love seeing these home values go up the last 5, 7 years, and we're all, hey, patting ourselves in the back, we can't have 10% gains a year. You know what I mean? That we
Every
don't,
year,
and we
always.
don't
Yeah.
want that. We don't want that, right? It's just not sustainable. So when you are buying, and that's just something to be caught. I'm not talking people out of buying a new construction, but I just use as an example because in our area, where did we see the neighborhoods that were hit the hardest, right? At the time, it was the homes that were built. So you're seeing an empty home with a for sale sign on it because it was a foreclosure in 2009, 2010. It was built in what, 2006, 2007. And what happened was people started losing jobs. So they could afford the payment until they lost their job. And then Bob across the street, he lost his house, which affected my value because we all paid the same price. We all did low down payments, whatever. So even regardless of the kind of loan, the ARM, the interest, all of that's kind of a moot point in that example. It's just that we are all in this boat together. And depending on the life cycle of the economy at that time, it could spiral where all of a sudden it's like, well, now I got a job change and both these guys lost their homes. So I'm gonna at the time walk away from my house because I got to go take this job across the country, and it's kind of spirals it from there. You know what I mean?
Yeah.
So it's just something to be aware of as we get into an inventory market where maybe you do have some choices to go, unlike it has been where it's like take it or leave it.
Yeah, true.
That's just my perspective on it. That's what I've seen. You know?
So I wanted to pivot on something before we wrap up, and that is like, and I used to struggle with this topic, to be honest. Short sale versus foreclosure. Why would I do one versus the other? And then when I really started to think about it and kind of revisit that idea lately, it did become a little more concrete for me and a little more tangible. Meaning, if you do a short sale, we're taking the pain now and we are kind of getting through the event, which is the closing of the short sale, and then we can start to repair credit. And so up until that point, there's really not a huge difference because in both scenarios, you're typically going to go behind on payments. And I used to think when things were really bad, I used to think like, oh gosh, just put the keys in the mailbox and why even bother? But there is a reason to bother. I think if you go through the short sale process, you're working with your lender, you keep your other things like credit cards, car payments, et cetera, current. Maybe you take a 50 to 100 point hit in your credit, but then it ends relatively quickly, like within a year, probably quicker, probably within 6 months. And then you can start the repair process and move on. Versus going through a full foreclosure, which could take who knows how long, a year, 2 years. And then your credit score probably isn't getting a 50 to 100 point hit. It's probably getting the maximum hit that it can at that point. And I just think you're kicking the can way further down the road. You're passing up on opportunities because your credit score is going down, meaning you're going to pay more for cars, you're going to pay more for credit cards. You may not be able to rent a place that you really want because your credit's not in a good spot, whatever. But what's your take on this short sale versus foreclosure? Like, what would you advise your
Oh,
clients?
easy. Here, so as you're speaking, I have a cork board right here. I can't move my camera. On my cork board is a faded piece of paper that is probably from 2010. It's a grid of every loan product out there. And it has short sale, foreclosure, what it looks like if you have a chapter 7, chapter 13, if you want to get a Fannie loan, FHA loan, things of those natures. So for example, and these guidelines haven't changed. So for example, if you have a short sale, you can buy a house within 12 months if you didn't go default, within 3 years if you were behind, right? On Fannie Mae, you have to wait for 7 years to rebuy a house, right? So it's not just about FICO score. It's about I went through this hard time. And those of you that are might be missing something, the short sale is getting in front of it. A foreclosure means you let it go all the way to the point where it went to the courthouse steps and the judge hit the gavel and now it is a bank owned property. So this verbiage is very important because people get lost in the pre-foreclosure, this, that, whatever. It's really not. It's in default until it's foreclosed, and it's up to that seller to go out there and decide they want to do the short sale. And what Cale's saying, yes, your FICO score is important, but I'm also looking at going, dude, you've been 24 months out of this foreclosure or this short sale, dude, you can buy a house again, right? So we all
Huge,
know,
huge difference between 7 years.
oh yeah, and we all, and we all know people that during that market at the time where, yeah, man, they went through it. They had a short sale, they bummed, but guess what? They moved counties. They got a new job because they got laid off in Riverside County. Within 24 months of renting, they're in the market again, and they caught a piece of that upswing while the market was down, right? So I'm always an advocate of doing what you said you were going to do to the best of your ability, right? You said you're going to make that mortgage payment. I don't even like a lot of the blame that got placed on stated income, things like that, because I did multiple 100% financing state income loans, and one of them is a paid off rental that I've had for, paid off for 10 years. So it was a good decision for me, right? So I am a huge advocate of go through the short sale process. Now, with that being said, the short sale process before, because of the servicing agreements, tend to be much more difficult. Something that hasn't come to light yet is that through Dodd-Frank, through a lot of these revisions, the servicing agreements have changed with Fannie, Freddie, FHA, VA, where they've kind of realized it doesn't make sense if there ever was something catastrophic to quickly foreclose on people and dump a bunch of empty homes on the market. The banks will work with you now much more than they did in the past. When I was listing and selling REOs, yeah, as you remember, you walked up and knocked on their doors and they told you the stories. Some of them were people that they actually got foreclosed on when
And they
they
were
weren't
trying to
even,
sell or whatever. Yeah,
they were
yeah,
trying to keep it. Yeah. Or
yeah,
back then, the biggest one was back then, if you were 4 months behind, you had to make the 4 months up right there. Like you had to
yeah.
pay the payment. Now, since COVID, we all know the word forbearance. Back then, forbearance might as well been like a unicorn. Like we knew about it, but they never
No
granted.
one, yeah, no one was utilizing it.
Yeah. Now you can quite often call them, hey man, this is what's going on. That was COVID, a TBD on what's going to happen, but it's my understanding obtaining that forbearance is a lot easier now. Where basically nobody wants to have a flood of empty homes. A normal life cycle, and I don't think we're ever going to see that. I don't think we're going to, but a normal real estate market has some kind of defaulted sales. And kind of like your point too is I think that we're going to see more short sales than we are foreclosures. But that doesn't mean we're going to have zero. It just might mean that some people just choose to not do the short sale, let it go back to the bank. But the short sale should be a lot smoother because even by the time that market was ending, arguably 2016-ish, the short sale process was getting more tech savvy, running it through different platforms rather than fax machines, getting it
Yeah.
much more a quicker process to get in front of it, right?
God,
So
I remember literally faxing documents on short sales. But
so so
so bad.
if you remember that, I had somebody in my office that was their whole job was faxing things, calling, making sure you got the
Yeah,
fax, writing down, oh, I talked to Barbara and she confirmed she got 25 pages, and
yeah,
then following up once a week. Hey, just want to see where we're at. And again, going like we were saying, that was the infancy stages of the internet. By the time we left REOs and the defaulted market, things were being ran, even Fannie Mae, therefore their short sales were being ran through Equator, just similar to their REO process.
yeah.
And their asset managers are the ones that were managing the short sales too. So to me, that goes back to the opportunity thing, right? So you as an agent, you never want this for your client, and it's not an opportunist thing. It's more of like education, short sale versus foreclosure. Foreclosure, you might be able to not make some payments a lot longer, but it's going to be a lot
A lot
longer,
more long-term damage to you as a person to be able to buy many things.
many things. And on the flip side of it too, I've had to counsel buyers back when there's multiple short sales of like, are you a buyer for a short sale, right? And a good example of that are people that are, hey man, it's June. My kid's gonna start MV in August, and I want to have this school,
Yeah,
whatever. It's like,
that's
dude,
not for you.
that's not for you. It's not for you. Like uh I used to tell people like the best short sale buyer is somebody who already has a place to live with month to month or doesn't care. They don't need that house. If it works, great. If not, then there's another one. Or hey, this thing is at 500 grand. Push comes to shove, I'm willing to go up to 600 grand because remember, people out there in the internet world, on a short sale, if you are the homeowner, if the bank takes a $200,000 loss or $300,000 loss, it doesn't really affect you much at all. So on how much of a loss you took, right? So that consumer getting in there, the buyer, as long as they're not maxed out, where if the bank comes back and says, hey man, we want 550, and it's hard to negotiate in a contract, but in verbal conversation, can they qualify for 50 grand more? Okay, just want to make sure in the event that it comes back and we can have that deal, because that process might take 30 days right now when there's no short sales, but that process might take 45, 60 days if it starts beefing up.
Yeah, that's a good point.
So
Speaking of which, before we wrap, one last thing. Zillow, pre foreclosures. I know you get calls on this all the time. People are always confused by that. Say a little bit about pre foreclosures on Zillow and what that is.
so what sparked this whole conversation was an agent calling me going, Wes, can our buyers that I've pre-approved, their VA, can these guys buy a pre-foreclosure with a VA loan, right? And it kind of melted my brain a little bit because I thought the agent should know this. But then when I realized it, I'm like, how would she? So I think this is what you guys need to know. Zillow is not meant for the consumer's benefit. It is designed to capture clicks, calls, this, that, whatever. So they use every piece of tool they can to push out onto the internet to make people call in, right? So one thing they've been doing since the invention of Zillow is they will advertise houses for sale. So for sale by agent, for sale by owner, those kinds of things. But what they also do is they are legally allowed to market public information. So when you stop making your mortgage payment anywhere between 60 to 90 days behind, the servicer will record what they call a notice of default. A notice of default is then public information. Your neighbors can go look it up and see that you have an NOD filed. So what happens is Zillow will advertise that property as a pre-foreclosure, right? But again, going back to what Cale and I talked about, until that seller says, I want to sell my home, the property's not for sale. But they can legally advertise it because it is in foreclosure, and it will remain in foreclosure until it actually then goes to the courthouse steps and then becomes a foreclosed property. And then even then, once it's foreclosed, the bank now has to take it back, do the evictions, and put it for sale. So one thing you don't even see that, Cale, is you see pre-foreclosures popping up because somebody's behind. And then later on down the road, it might say bank owned, but it's not for sale yet. So the biggest reason why
Yep.
this is important is you can't bypass the homeowner. You can't go around them, right? So I can only imagine if you have an NOD filed right now, you're probably already getting pounded by listing agents,
Oh gosh, yeah.
flippers. I can
I'm
only
sure.
imagine.
Sure.
So I think it's horrible personally that Zillow puts it out there that it's a pre-foreclosure because consumers think, oh, this is a good deal. Oh, this is for sale. But it's not. It's not even for sale. All it's basically happening is, hey, these guys are going through some financial troubles, right? That's all it's really advertising. So it it's important to know that this is why we have brokers. This is why we have people like you and I who have dedicated our lives to navigating this market because everybody else just wants something from you, right? We don't get paid unless you get a house. That's
Yeah.
what I tell
Yeah,
people.
true.
It's like we're not interested, in trying to make you click on something and capture information and selling it to 15 parties. That's not what we are here for. So, do you have anything you want to add on that? That's how I understand that process, and that's what I've experienced.
No, it's the same thing. And I'll just say it's frustrating for me as an agent
Hmm.
because it gives your clients this false hope of going down, we're going down this whole rabbit hole of something that's not even attainable. They're super confused about what a pre foreclosure is, anyways. They assume it's for sale, by the way.
Correct.
They assume it's like a bank owned property or like something that is listed for sale, even though it doesn't say for sale and it just says pre foreclosure. It's very confusing. And obviously, why would Zillow do that? Because it creates an action. It creates that client clicking, I want to learn more. And then now they're put in touch with an agent that's going to call them and try and switch them to another property. That's the whole reason it's there, guys. And but it's just so frustrating for me because I have to unwind that whole thing and have this lengthy discussion with my client, which ultimately just ends in them being a little bit like perturbed by the whole thing because why would a company do that to me? Essentially, is how they feel. But it is what it is, guys. This is, it's a
Right.
capitalistic environment that we're in. This company is there for profit. They are looking to capture your information so they can physically sell that to an agent and say, hey, I gave you a lead of a buyer that's interested in looking at property.
Right. And that's where it's like, and I don't want to pitch my services on this, but it's important to know that I'm sorry, consumers, buyers, borrowers will call me sometimes and almost want a second voice of reasoning on what their realtor's saying,
Yeah.
right? And I can't tell you how many times people don't trust the realtor because they haven't showed them this house, or they don't explain what that is properly, and they feel like they're holding this property and I can't, they won't show it to me.
Yeah.
And I
Yeah.
have,
Yeah. Right.
it's not for, so I like to walk them through the way that we just did and explain of like, look, man, just like we just did, and it helps them understand this, where I hope from this video, a lot of realtors start understanding that it's not about if, it's about when. And right now, there may be very little, but there may be a lot more. I distinctly remember watching the MLS go from standard sales to primarily standard to primarily short sales to, always a mix to primarily REOs to back to primarily short sales to standard sales, right? So, like, we're going to see that mix of inventory, and again, a healthy market always has a mix
Yeah.
of inventory. And so these every agent needs to be well versed on all of these things, because you don't want to come across as if you're uneducated, even if you are. Like, it's okay. I'll never forget when because we were working leads in the mortgage world, right? The lead market dried up, and me, whatever I was, 24 years old, had to go out there and just build a database that I did not have. And at the time, like I was telling you earlier, it was super negative. Like, everyone's like, "Oh, yeah, you're in the real estate. Sorry for you."
Yeah.
But I got fake it till you make it, man. And we sold empty homes that were foreclosed, and we learned it really fast, really quickly, and real quick. You were able to adapt to that market and understand this is a short sale, this is a HUD foreclosure, this is a Fannie Mae foreclosure, this is Bank of America, that's a home
Yep.
path property, and that stuff. Just like right now, right? You want to make sure that you understand high bonds over here. Solar contracts is a big one that a lot of agents didn't know for a while. New construction versus resale. All of these things. This is just another thing that the good agent will at least get some exposure to it and start watching for it.
Yeah. I think that's the thing here is this is a tool you should familiarize yourself with. I highly encourage you to get involved in a short sale so you can
Hmm.
figure out how the process works. They're a little more complicated than a normal sale, but they're not impossible to learn. And with a resource like Wes helping you out through that, I think it's definitely something that's attainable, and I think it's something you should like actively try to do a couple of them to get familiar with the process because they're really not that bad once you get through them.
I couldn't imagine an agent being scared of them, in the sense where if a client calls them and they're upside down, they're like, don't call me back. But maybe there is, maybe there are. But another point of that is, like, again, I'm not pitching my service, but what happens is, if an agent wants to write an offer to short sale and I'm doing the pre-approval on it, I'm going to walk that agent through and go, okay, that's cool. You're going to go at 400 grand. No big deal. If that bank comes back at even 410, their DTI is capped. That deal is not going to
Yeah.
happen. So you and the listing agent need to be on the same page, because at that point the seller is saying, agents, whatever, bro, get it out of here, okay?
Yeah.
Because they're not coming out of pocket. So this is where the agents are able to talk to each other. And again, none of this is shady. None of this is bad. It's about servicing the clients, right? You don't want, if the comp range is 4 to 420 and you want to go in at 4, you want to make sure if in the event it comes back at 420 and the client's good for it, they can qualify for it. Even if they decide not to move forward, you want to know out of the gate, like, hey, can they qualify for more? Meaning the negotiations are a little bit different, because it's not about milking the consumer for as much money as they can get, because the objective is to get into the short sale process, process it quickly, and close it as soon as possible for both buyers, sellers, agents, everybody. But the sellers in this example, as soon as the short sale's done, it stops the default that's damaging their credit.
Yeah, and then they can move on repairing their credit. And the lender can move on without the worry of like, oh gosh, this is going to be a property we're going to have to foreclose on. Then they have to take on attorney's fees, and now their assets tied up for even longer. They don't want that either. So
I have to imagine that what you just said is more than 100% true. With the tech that we have today compared to the way it was, I have to imagine that even just automated value reviews of like, okay, in this example, you're at 400, comps are 4 to 420. Send me some pictures. Okay, it's got damaged carpet and the pool's green. All right, we'll take 400, move along. I would have to imagine. But when I start thinking logically, I always tell clients like, hey, these foreclosures, these short sales, they don't really work logically because the guy on the other side of the phone or the other guy on the screen is a clock in, clock out, 9 to 5. He is not commission based. He is not in sales. He's got a pile.
they have a threshold. They have a number that they
Yep.
want to mind. That's going to be, in my opinion, I've always thought this. It's always a percentage off of what they feel like the average price of a home is in the area. Meaning, I have no scientific friggin' backing for this, but it just always kind of felt like this to me. Like if a home's worth 400, they would go, "We'll take like a 5% variance on this house."
Yeah.
So 5% of 420 grand. Would we sell it at 380? Yes. Would we sell it at 375? No,
And
because we need to get at least 380.
that is such a good outlook on it, and that's an educated outlook. And obviously, we've seen more, both lower and higher, because there are things that are even above my head sometimes. Where, like, I've been to foreclosure auction before with my cashier's check. Like, all right, I'm a big dog. I'm gonna go buy some foreclosure homes, right? And then the way the banks set their prices and stuff, and I'm like, where did that come from?
Yeah.
And it has to do with their insurance on the loan. And that's one thing we haven't talked about, where the short sale process can be very, very frustrating because so much is shielded, so much is guarded. And it's not even that it's purposeful. There's just things that they don't know until the whole package gets processed, right? So if there is PMI or MI that covers a certain amount, we don't know. Sometimes they actually make more money by letting it go foreclosed and it was insured and whatever it is. That we've seen houses before where you're like, wow, you didn't take our short sale offer and you just foreclosed for
Yeah.
$20,000 less.
Yeah.
And we're sitting there going, why would you do that? Right. And I
There's
mean,
always
because
a reason.
yeah, there's always a reason. And and you mentioned like attorney fees and stuff. There's also eviction costs. When it's a short sale, the sellers agree to get out of there, whatever. It's a bank
Yeah.
owned, they got to go evict and do this other kind of stuff. So I do believe that that market, I remember talking to my asset managers at Fannie Mae, and I remember them talking at the time of like, because I asked them, you build relationships, like, why don't you guys do more deed and lose? We haven't talked about deed and lose, but deed and lose or more short sales or whatever. And it was because the servicing agreement, there's so much involved that not on purpose, but the way that it was designed was that they just denied it all and foreclosed. Now, going into this market, I have to imagine that there's going to be more flexibility in that, right? So just you just have to know that going in.
Yeah. No, I think so. And I think this is probably a good place for us to
Yeah,
wrap. We blabbed on for like an hour about this.
you know
This
me,
is
man. I'll talk forever.
Well, maybe we do some future videos, follow up, like dive into a few of these specifics and go more in depth. But I would just encourage you, if you're a realtor out there and looking to get some education on this, Wes is an excellent resource for you to check out. And, he really is there to help you out. And I know he doesn't make money on when you're a listing agent on a short sale, but I don't know if he can help pre-qualify buyers for you or add some value in that way. But he is a great coach and does know the process better than most realtors regarding short sales. So use him as a resource for sure.
Yeah, man. I appreciate it. And that's the bottom line is I've been in the Valley for 20 years. I don't advertise. We don't do leads. I'm all about building relationships. So, like you said, maybe there's not a deal in this conversation, but there'll be a deal in another conversation. That's
Yeah.
always kind of my objective.
Cool. Well, right on, Wes. Appreciate you hanging out today and talking about this. And we'll see you on the flip side.
All right. Thanks, man. See you.
Peace.